We don't expect that. We think that the details on PEP and APP will come later on in the year, and relative to the pace of PEP's purchases, maybe in September when we have the new forecast, this could come around. A dovish surprise, however, can still come if the president of the ECB suggests that, whether they continue to buy via PEP at significant higher pace after March or not, whether PEP is expanded or not. It's less relevant than looking at the entire pool of asset purchases. In our own forecast, we expect that the ECB will continue to buy about 700 billion assets next year, a combination of APP and PEP.
Well, I guess the bar is relatively high today for a dovish surprise from the ECB, given the signals on the back of this strategy review. So what difference do you think today is going to make from a market perspective, given positioning into today's policy decision?
I agree. I think the bar at this point is high. I think from a market perspective, it's important to understand the persistence of the monetary policy accommodation. The fact that this broadly accommodate policy stance will continue for a long period of time. And again, the market at some point before this strategy review was thinking that after March, APP would just continue at 20 billion per month. If there is any hint that the pace of asset purchases after March of next year is going to be significantly larger than just 20 billion, that would make a difference. The persistence is important because obviously markets will know that the ECB is more determined to achieve the 2% medium-term inflation targets. And by putting emphasis on a flexible framework that tolerates overshoots will also help understand that, low rates QE is to stay here for long, given how far the ECB is from meeting its mandate.